how do I research stocks? So you found a stock. Now, how do you find the important information that you need to know on it? Well, each stock needs to be analyzed in a different way because each business is a little different and each industry is a little different. So the first steps you take are seeing how revenue moves through the company. So this is seeing revenue, the cost of revenue, the operating income, and then the net income. Next, after you find out how the revenue moves, you see how it's allocated. And so this determines how it's being spent on investments, how it's being spent on infrastructure, and how it's also being spent on paying debt. When you find these important factors, you can evaluate if it is worth more to go into and if the company is worth the investment. So first, let's start with the sources of revenue. In businesses, identifying where and how revenue is produced is the most important factor when researching a business. Like, you need to know how they're getting their money. So I'm going to use Starbucks as an example because we all know Starbucks gets their money from selling coffee. So companies like Starbucks gain revenue from producing coffee as well as selling it to consumers and retailers alike. So now we know that this is their revenue. So we can also infer that profit margins will most likely be around 50% because the cost of coffee compared to how much Starbucks charges for is probably a 50% margin. We know Starbucks has also expensive drinks that are like $5 or more, and this extends the gross profit much higher. Now we can also see profit margins on Yahoo statistics page, and this will show how much gross profit it is. All right, so after we looked at how much gross profit they have after they apply the cost of revenue to it, we can infer that operating income before expenses is going to be fairly high because of the large profit margin. Now, we know that to sell coffee, we also need people working at the Starbucks shops. And this is also another large cost taken out of the operating income. So this is called selling and general administrative costs. And this is applied to the cost of the net income. So we take out the administrative costs, we take out the cost of revenue, and what we're left with is the earnings before interest and taxes. And with large companies and the large operating income like this, I'm going to be very critical of how they allocate it, because this is the best thing about Starbucks, those huge profit margins and the simplicity of just buying and selling coffee. So now we know how revenue is going through the company. Now we can see how the net income, which is what's left over after all the cost of producing that revenue is taken into account. We can see how the net income is allocated. So we see for Starbucks that depreciation and also changes in liabilities, if you go to their cash flow sheet, increase the cash flow by almost double. So now with this doubled cash flow, we see that half of it is going to capital expenditures and investments, which is exactly what should happen if a company has a lot of cash, because cash is an asset, but a better asset is long-term investments because those have higher returns than the value of cash. Now with this information, we can see if the amount of debt they have is acceptable. And this means that if they have a high cash flow and they're investing it into future long-term investments, if this will be able to pay off their debt that they do have. And it looks like Starbucks will be able to pay off that debt because they invest a lot of cash into long-term investments and they also have a high net income. So after we know where the revenue goes through the company and how net income is allocated into investments and producing more net income, we can look on Yahoo Finance statistics page and see if we like what their numbers are. Now, the numbers we focus on are going to be a little different because we took into account their sources of revenue and how net income is allocated. And looking at the numbers is all according to your trading set of rules. So the first thing I'm going to do for Starbucks is, because they have large income, I want to see how much of that is returned to its shareholders. So their return on equity is 47%, which is exceptional for a company that's also growing. So now I know that most of the net income is going back to shareholders, which is really great for me to see, especially with a growing company like Starbucks. So Starbucks is also a large company, so I want to see how many years it would take to recoup my investment, With the forward price to earnings ratio of 24, well, it looks like it would take 24 years to recoup my entire investment. But it has that higher PE ratio because it's still expanding. So now that I have this information of revenue, the net income, and also some of their return on equity as well as the price to earnings ratio, I can look into their 10K report and also the most recent 10Q, which is the quarter report, and see if I want to make an investment. Now, I take all this information, this initial information, and I make a decision. I choose if this is the correct industry for an investment right now, depending on the market. I choose if I know enough about the business as well as the industry to be confident in evaluating how the business is run, as well as what decisions they make with the business. Because if I don't know how it works, how will I be able to be critical on their decisions? I will also make the decision if they allocate their income back to their shareholders appropriately, which is through ROE as well as price to earnings ratio. So then I want to go into their growth. Earnings per share growth for the previous 12 months is $2. Now, at a purchase price of, let's say, $60, you earn $2 per share. So if you have one share, after a year, you will get $2 back. It doesn't work like that, but it's just a way to calculate how much the stock is worth compared to how much the stock earns for you. So with earnings per share of $2 and a purchase price of $60, we get a price to earnings ratio of about 30. Now, with 5 years growth at a growth rate of 13%, which is Starbucks' current earnings per share yearly growth, we're going to see earnings per share at $3.72, up from $2.02. Okay, so now if we take the new amount of earnings and we own the stock at $60, well, then now the price to earnings is only 16. So this is why owning a stock that has earnings growth will be very beneficial in the future, because with a PE of 16, this means that after 16 years, getting that earnings per share of $3.72, well, you'll get your $60 back. It doesn't always stay at that same price to earnings ratio. So if we compare the previous $30 price to earnings ratio to the new price to earnings, well, a stock price will have to be $110. And this is where the money is made, because by showing how much earnings is growing, it's showing how much you can earn back after you purchase one share of the stock. And with that, people will pay more if you earn more. So this is why the stock price goes up. What I did here is a really simplified way of how Warren Buffett calculates the intrinsic value of share price. So right now, the current share price at $60 is a PE of 30. Now, a better price to get it at is around 55, because you're going to see after 5 years at this growth rate, well, the PE is going to be even lower. So this is what you want to look at when you're looking at growth, how that growth will change the earnings per share over time compared to that is how much you purchased the stock for. So if I purchase the stock for $60 and 5 years later I get $3.72 back, well, I'm going to earn my money back quicker. And this is why the stock price goes up. I kind of can see where I think is a fair value share price for the company. And it looks like around $55 or $60 is a good price. So now I can set my enter and exit plan accordingly to how I value the company. So that was the video. I hope you like it. It was a quick rundown on just how I process a stock that I find. So make sure you leave a like and also subscribe. I'm going to have a analysis on Sunday on a company, which I'm not going to say now, but I will. And make sure you check out Sunday's video because I always have an analysis.